two things. We can have the whole area as an area of interest, and within that area of interest, we will have our point of interest, how to select them. Then we also look at how to get a clean point of interest. And then we look at trade entry types. We have the aggressive and the conservative or confirmation. Then we look at the top-down analysis by taking a pair and see how we can do the top-down analysis. And after all, we put all these concepts together and then look at a live trade. All right. So now we are going to start with the advanced market structure. So we know what a market structure is. In every trading concept, either you trade the normal price action, that is support and resistance, you trade smart money concept, you trade ICT, you trade what and what, we all follow market structure. That is where we have the bullish market and a bearish market or a range market. And within a bullish market, we have what you call a series of higher high and higher lows. And then within a bearish market, we have a series of lower low and lower highs. Then with that of the range market, we have what you call the equal high, equal low, equal high, equal low. But when we come to smart money concepts, we have the same thing, all right, but we want to go through the advanced one. We know that the normal market structure we all know, either from basic demand and supply or support and resistance, we all follow this that I've already said. On a bullish trend, we all know that this is a low and this is a high, and this is a lower, this is a higher low and this is a higher high. Why do we call this a higher low? Because this is a low but it is higher than this one. And then why do we call this a higher high? This is a high but it is higher than this one. So this was what we were taught. This was what we were taught when we were all learning the basic support and resistance. And if this is what the market is going to be forming, then everyone will be able to make money. Is that not it? Everyone will be able to make money. Mr. Alas, are you talking?
Yeah, I was saying, first I couldn't see the screenshot.
But can you see it now?
Yeah, it's now.
Okay. So as I was saying, this is a basic market structure. We all know that price doesn't play like this. On the live chart, price doesn't play like this. So if you are learning support and resistance or any concepts which didn't tell you much about structure, then you will be losing more trades or you'll be missing more trades. So that is where the advanced market structure comes from. And within the advanced market structure, we have different types of structures. We have the major structure, which is the main trend structure. So let's say we are in a bullish trend, or we are in a bullish market, which is this one that I've drawn. And we know that in a bullish market, we have higher high, higher lows, higher high, higher lows. But within the higher high, we have what you call a substructure. Within the higher high and the higher low, we have what you call a substructure. And also we have what you call a minor structure. So let's say this is a bullish market. This one, that's our bullish market. So this move from this low to this high, then up to this level, this is our main structure. Are we together? That is our main structure. So within the main structure, we have a substructure and a minor structure. So let's say this move here to here, that's a main structure. So the pullback, there's no market that goes up without coming down. Whenever a market goes up, it will pull back before it continues. So that pullbacks which occurs here before it comes to hit some point of interest here and then continue with its bullish momentum. That pullback is what we call a substructure. That pullback is what we call a substructure. And then when the pullback, that is the substructure, comes and hits some level around the point of interest, or come and hit a point of interest and started to continue with its main trend, that structure that is forming before now going up or going to continue with its own trend is what you call the minor structure. The minor structure, that is an internal structure formed within the main structure. So now let me give you, this is a textbook as perspective. So let me show you what I mean here. So looking at this drawing I've made, I just want to give a diagram illustration. We will go to the live chart and then we will see this in detail. So now this is what we have here. Let me move this one. Good. So look at something here. So this is a bullish market. We have what you call, I don't know, okay, I know of the two of us, Mr. Yakub, Mr. James, we all know in smart money concept, we all know what a break of structure means and a change of character. We all know, but I don't know of Mr. Ibrahim. I don't know of Mr. Ibrahim. So if Mr. Ibrahim can talk, and then we'll see. Mr. Ibrahim. Okay. And Mr. Kennedy. No, Mr. Kennedy, yeah, we for it. And Mr. Joseph. Mr. Joseph, we are welcome.
Please continue.
Okay, good. Okay, good. I then that means you also know what a break of structure is. Okay, good. So now we all know that in a bullish trend, price breaks structure to the top, whilst in a bearish trend, price breaks structure to the down or to the bottom. So now within this basic market structure, we have a substructure and a minor structure. So looking at this whole thing that I've drawn here, that is the basic market structure. That is the basic market structure. And within the basic market structure, each move and a pullback has we call a substructure and a minor structure. So now the whole of this pullback, let's say this is the beginning of the trend. So the whole of this pullback is what we call the substructure. So when a pullback is happening, it doesn't come straight with a straight line. It creates some structures within. So that structure is what we call a substructure. And in order for us to confirm this substructure, we will need something we call a change of character. But I'm not going to cover it now. We will cover it when we go to a swing high and swing low, how to identify swing high and swing low. So now let's continue. So now within this basic structure, this is what is also happening. Please, just a second, so I'm coming, please. So now within this basic structure, we have this structure also formed. So this is a break of structure. That is this break of structure. Then we have another break of structure. That is the second break of structure. And then we have another break of structure. That is the third break of structure. So you see how the advanced market structure work. We don't have price moving straight like this. It always moves like this. So now, before you confirm your substructure and your minor structure, we have what you call swing high and swing low. And also we have another one we call trading range. And then let's look at the bearish momentum or the bearish market's own. The same thing with that of the bullish market. This was where we are. This one also have a break of structure to the down, another break of structure here, then another break of structure here. Good. So let me clear this one. All right. So now this basic market structure also have this form within that. So we have this break of structure here, and then another break of structure, then another break of structure. Okay, so this is what happens on the advanced market structure. We don't have price moving straight like this. So now within this market structure, we have a trading range. You cannot just come like this and begin to take your trade at any point. You must look at the range at which price is currently trading from. So now this leads us to what we call the trading range, or a swing high and swing low. But before I move to that, I would like to ask a question whether anyone needs a clarification from this diagram. I will go to the live chat and then we'll look at it very well. This is just a diagram explanation. So as I said, let me use the call out tool and show you what it means. This from here to here is the main structure, and the movement here is the substructure, and the continuation is the minor structure. So you have to know these three things. You have to know these three things. It will help us when we go to the swing high and swing low, how to confirm your trading range, because most people tend to take unnecessary loss because they are not aware of where the trading range is. They are not aware of where market is currently trading and how they are going to use those range to capture trades. Please, are we together? Hello?
Yeah.
Okay, good. Okay, so now I hope we've all understood the main structure, substructure, and the minor structure. The main structure is the overall trend of the markets. Then the substructure is the pullback, and the minor structure is the internal structure that is formed when price is now continue with its own direction. So now let's go to what we call the trading range. I want us to capture the textbook perspective, then we can go to the live chat and look at something there. So now with trading range, that is how to identify a swing high and a swing low. Within a swing high and a swing low, we have what we call the discount and that of the premium level. So you need to understand this discount and premium level in order to know where to take your trade exactly. Because if you don't understand the discount and premium zone, you may be taking your buy within a premium zone, which is very wrong. Even though the market can decide to respect your buy, but it is wrong. You know, as a normal trader, just a normal market trader, like those who goes to markets and buy and sell, no one wants to buy something at a higher price. Everyone wants to buy it at a discount price. So whenever you are to take your buy, you have to make sure you take it at a discount zone, and also when you are to sell, you sell it at a premium zone. So in smart money concept, or in advanced trading concept, in advanced smart money trading concept, we use Fibonacci tool, or we use the Gann box to measure our trading range, that is the discount and premium range. So now let's look at how to identify the discount swing high and swing low. Let's look at how to identify them. Good. So now look at something. We've already covered what we call the minor, sub, and that of the main trade. So now, assuming we are in an uptrend, we have this as our main trend or as our main structure. Then within the main structure, we have something like this. We have something like this. We have something like this. And then price comes and takes this. So look at something. Now, this is a demand zone. And we already know that from our market direction, we know we are in a bullish trend. And we know that a market doesn't go straight without a pullback. So from here to here is our swing zone. So this is a swing low and this is a swing high. But how do we confirm a swing high and a swing low? That is what we are now coming to look at. So we know that within a trading, within the main trend, we have a substructure. So in order to confirm a swing low and a swing high, you need three things. Let me list them for you. You need to see three things. One, you must first see a sweep of liquidity. A sweep of liquidity. So we will look at liquidity when we get to that aspect. A sweep of liquidity, and I know most of us already know what a liquidity is. Then you must get a change of character, and then you must get a break of structure. So these three things confirms a swing high or a swing low. So look at something. From this zone to this zone, this, let's say it plays something like this. Something like this was happening. Something like this happened. Something like this happened. Okay, and then this one, let's say no, this like this happened. This one swept this and then broke this. So this level was now confirmed as our swing low. But for this high to be confirmed as a swing high, we must have this. The substructure should give us something like this. Then takes out this last low for us to confirm this swing high. So you know that this is a liquidity sweep. A liquidity sweep occurs when a candle takes out the last low before it breaks structure. So assuming we have something like this, so this is our last low. Then a candle came and swept it with a wick. We all know what a wick is. Then took out this high that it formed before sweeping the liquidity and comes back like this and continue. So this zone, this candle, this one, this is a wick. Let's say, assuming this is a wick. This candle that swept this last low, this candle is a candle that swept liquidity. We'll go to the live chart and then we'll see it better. So this candle that swept the last low, this was the last low before this sweep occurred. That candle is the wick that swept that low is the beginning of our swing low. So now that we have this sweep and then a change of character here, and another break of structure here. So this low now has been confirmed to be our swing low. So now for us to get a swing high, let's say when price swept this liquidity, change character, broke structure, it is now currently around this zone. So at this zone, we cannot confirm this zone as our swing high like this. We cannot confirm this as our swing high because this is just a normal high until we have something like this. We have something like this, we have something like this, break of structure, and then this, and then comes and takes this. So until we get the minor structure, so this is let's say this is a bearish trend. This is a bearish trend. So now price was coming from this low, from this high, and then it did something like when it gave us this last high, swept liquidity, and then that last high was being taken. We have then series of break of structure within the substructure. We know this is the main structure, so the pullback is a substructure. So before we can confirm this as our swing high, we must, let's say this is a point. Okay, we must see price taking the last low that breaks structure to the top. The last low, so this is the last break of structure to the top. So we must see price taking out the last low to give us a change of character to confirm that yes, price is now trying to what? To continue its bearish momentum. So now this last low being taken, confirm this our high as a swing high, and then this as a swing low. So in this case, from this swing low to this swing high is our trading range. So anything above this, you don't bother yourself. You only consider this zone from this swing low to this swing high. So that is where you are going to consider to be taking your trade from until price takes out this low or takes out this high. Let's say take this out, this low, or maybe goes back and take out this high. Then your trading range has been invalidated. Now you look for another trading range. Please, are we together?
Yes.
We are together. Okay, good. So I don't know whether we have gotten the concept of the trading range. Hello? Okay, so now this is our trading range. To identify a trading range, you must first see a sweep of liquidity within a key point of interest. That is the main thing. A sweep of liquidity within a key point of interest. We will look at a point of interest in few minutes to come. And then we must see a change of character and another break of structure. Then we can now confirm our swing low. And in order to confirm a swing high, we must see a last break of structure and its low being taken out to give us a change of character. But please note that the change of character that happens to confirm our swing high here, this change of character is not telling us that the whole trend has changed direction. No, this change of character is only to tell us that our trading rate has been confirmed. So now we are going to stick to taking trades within this range and nothing else. So that is the reason why we must see this. And this is a substructure. I told you that this is the main structure on a bearish trend, and this is a substructure. And in order to confirm a substructure, we must have a change of character on the lower time frame. And then we have another change of character at the swing high to confirm our trading range. So now let's look at point of interest or area of interest. So please, can we continue? If there's any question, we can ask. Please, can we continue? Hello? All right. All right. Then
yeah, we can continue, but a question, just a question.
Okay.
Hello.
Yes,
Okay,
I'm listening.
For the swing low, it can be confirmed. That is for the break of structure and the change of character.
Change of character, yes.
But for the swing high,
yes.
Do we need only just one break? That is change of character. Only one break.
Yes, one break. Only one break to confirm the swing high.
Okay.
Yes, only one break.
What if it's a liquidity grab? Let's say price goes below a low and then it breaks the high again.
Okay, with that one, you know, liquidity grab happen with a wick. That one, this last break of structure is not a break of structure. Assuming, let's say this candle. Assuming, let's say this candle. Come here. Let's say this candle just swept this last high with a wick. So in that case, this is a liquidity grab. It's not a break of structure. It must be a break of structure.
Okay.
And price taking out that last break of structure low for us to confirm the swing low.
Okay.
Or the swing high, sorry. All right.
For the swing high, let's say price breaks the last low.
The last low, okay.
It breaks that low.
Okay.
And then it also takes the high.
It takes the high.
Takes the high.
Good. Now.
Yeah, sometimes.
Good. With a body candle. With a body candle.
Yeah.
Good. So now that means this our trading range has been inviolated.
Okay.
You get it? And for that to happen, meaning when it broke this, when it takes this low, for that to happen, when it takes this low, it came to a key zone. It came and activated a key zone before continuing its bullish trend. You get it?
Okay.
Yeah. And we know that this is the 50% of the gun box. I'm using a gun box, not a Fibonacci tool. So this is a gun box, this one. You can get it from here. I'm using the gun box, this one. So I've customized it to only show the 50% as equilibrium and then swing high and swing low. But in future, I will show you a plugin I also use to determine some of these things. Sorry, I'm saying plugin, an indicator, because I'm used to plugin. I'm also a web designer, so I use plugins a lot. Okay, yes. So for it to take this swing high, meaning it has reached a key point of interest and activated it and then continue with its bullish trend. Or maybe we couldn't get the right trend. You know, sometimes if you couldn't get the right trend, you may also find difficulty with your swing high and swing low. All right. So now let's go to point of interest. Point of interest or area of interest. So now, assuming we have something like this. Good. You know that when price takes us the previous high, it gives us a break of structure. So for price to continue its bullish trend, it must come down to grab some orders and then continue. So that is why the smart money concept makes sense in trading. Actually, at first I was trading support and resistance, but it didn't make sense to me. I don't know why it is buying or it is selling. You get it? Until I learned smart money concept. So smart money concept tells us that once there's an aggressive buy to the top, there are some orders left around here. The market makers will have to come back and grab these orders before they can continue their move. It's just like a normal market sellers. Assuming, let's say the price of fuel was trading at, let's say $10, and then something happens. Let's say something happens. All of the sudden, there is a high demand for fuel. So the market sellers, they would like to maximize their profits. So once they see there is a high demand for fuel, they will increase their, and also there is a shortage of it, since there's a high demand and the one in the system are not plenty, are not many. So they will increase their price. Is, let's say they can take it from, let's say from the $10 to $50. So when they do that, let's say the price of the fuel was here at $10, and now there was a high demand for fuel. So market makers or market sellers now increase the price to $50. So you see a rapid move in price. A rapid move in price to $50 here. So now, when it gets to the $50, the buyers being rational, they will also like to what? To minimize their spending. When it is at $50, meaning it is very high, most of them will not like to buy, forcing the market sellers to what? To reduce their prices. So when you go to the $50, there are some others here. Those who couldn't buy it at $50, they will still be waiting for the market makers or for the market sellers to reduce their price back so that they can also buy. So meaning there are some others here. People who couldn't buy it when it got to the $50 will be waiting for it to come down to $10 or to come down to, let's say, $20 or $30 around this zone for them to buy. So when they do that, now the price will fall and come to here. So those who couldn't buy it at $50 will now buy it at $30 around this zone and then move it to the top. So that is why smart money sometimes makes sense, but the basic one will not make sense much until you understand the advanced one. So let's say when it was coming, those who couldn't buy it at $50 will now look at, let's say, as a rational human being, when it is coming back, the sellers may also want to, now the sellers will not like it to come back to $10. There's something above it. So now those who couldn't buy it at $50 will be looking to buy it at $30. So that $30 zone or that $30 price cap is now an area of interest from within $30 to $20. That is where people will be now thinking of buying that fuel. So that whole $30 to $50 to $20 zone become an area of interest. And within an area of interest, we have what we call a point of interest. So now, those who couldn't buy it at $50 will now be looking at it to buy at $30. But we'll be looking to buy at $20. But within the $20, they will look at it, no, the sellers may not like it to come to $20. They will be liking to make it around $25. Are we getting it? They are likely to make it around $25. So now $25 become a what? Point of interest. Even though area of interest is $30 to $20. But within $30 to $20, we have $25. So that $25 is now our point of interest. That is the specific zone we want to buy. So that is why you see some people will mark the whole of this zone as their demand zone. But when they go to the lower time frame, they will now adjust it, known as zone refinement. So now they mark the whole of this as their point of interest. But when they go to the lower time frame, that is either 15 minutes or 5 minutes, they will now bring it here to be their point of interest. Are we together? So now
Yeah.
okay, good. So that point of interest, if it is in an uptrend, we call it a demand zone. And if it is on a downtrend, we call it supply zone. So around this zone. So now this zone, we call it a supply zone. And then let's look at what we call FVG, fair value gap or imbalance. All these are what will make a perfect trading strategy. Point of interest, liquidity, and fair value gap. They are what will make a trading strategy or an A plus setup. So a fair value gap or inefficiency, we know that for every market it must be efficient. It must be efficient. The number of sellers should be equal to the number of buyers. So where a number of sellers is greater than the number of buyers, then we have an inefficiency in the market. So the market has to balance it in order for us to be at equilibrium. So inefficiency occurs when there is a gap between three candles. When there's a gap between three candles in a price movement. So now this is a first candle, and then this is a second candle. So this gap which has been formed, it can be due to news or due to aggressive selling, either from the buyers or the sellers. That gap is what we call fair value gap. And a fair value gap, for it to be a high probability setup, it must be closer to a point of interest. So let's say this is our point of interest, and then we see a fair value gap around here, closer to it. So price is likely to come and grab that our point of interest. But let's say this point of interest, let's say this fair value gap is around here, and our point of interest is here, and the whole of here is an efficient price action. Efficient means there's no any fair value gap closer to the point of interest. So this point of interest may likely not hold, or even price may likely not even get to the point of interest, because that price around the point of interest is already efficient, meaning all the orders have been taken. So there's no need for price to come down to that place. It may likely mitigate the fair value gap and then continue. So sometimes you see people taking their trades from the fair value gap. That is because the remaining point of interest below the fair value gap is already efficient. When we go to the market, we see the live description or the live chart, and then we understand it. And then within a point of interest, I've forgotten to mention this, within a point of interest, there are 5 things we can look at, or we can look at the 5 types of point of interest. The one we have just talked is the demand zone, which is also known as the order block, or supply zone, which is also known as bearish order block. We have another point of interest known as fair value gap, FVG. That is what we've just talked about. So you see most people taking their trade from FVG. Yes, it is a point of interest. That is because the remaining price below FVG is already efficient. And then we have another point of interest known as mitigation block, and a breaker block. We call it MB and then BB. And then we have another known as reclaim block, that is RB. They are all point of interest. And look at it. This point of interest, they are of hierarchy. They are of hierarchy. One is stronger than the other. So if you don't understand this point of interest hierarchy also, you may be missing trades. Or I should write them in full, please. Should I write them in full? And look at this. Order block is the last among them, but that is also the most popular among them. Can we see it? When we are looking at point of interest, they are of hierarchy. Price mostly respect mitigation block, before breaker block, before fair value gap, before reclaim block, and then order block. So what we talked about here is the order block. And by SMC definition of order block, it is the last bearish candle. That is a bullish order block. It is the last bearish candle before the aggressive move to the top. While a bearish order block, it is the last bullish candle before the aggressive sell to the down. So that is an order block. But order block is the last point of interest to be respected when price is playing out. But there is something also I want to let you know. This order block, mitigation block, and breaker block, they all depend on the pair you are trading. So you have to backtest this point of interest and know that whether this pair respects order block or breaker block or mitigation block. And from experience, I trade GBP, JPY a lot. GBP, JPY, and BTC. From experience, GBP, JPY, it respects order block a lot. But with gold respects fair value gap, mitigation block, and breaker block a lot. So sometimes you can draw your zone, your order block, waiting for it to come and mitigate on gold, and then it will come and mitigate breaker block and then leave you. So let's explain what a mitigation block is, and then we go to breaker block, the order blocks. Then from here we now move to the live chart. Are we together? Okay. So a mitigation block. A mitigation block. Let me accept this person. Good. A mitigation block. Let's come. So this is a failed swing high or swing low. So that is a mitigation block. So let's look at something. This is an uptrend. This is an uptrend. So now we have a break of structure to the top. Here we have a break of structure to the top. Mitigation block is almost the same as break and retest. So you have a break of structure to the top here. So when price was coming back here, price was supposed to come and mitigate this order block or this demand zone here, but price didn't do that. It came and reacted to this and then continue to the top. So this zone here is what we call a mitigation zone or mitigation block. It's more like break and retest. This is a mitigation block. This one. And why do we have mitigation block? What is the rationale? The rationale of this. Why break this mitigation block? The mitigation block happens when smart money or the institutions, that is hedge funds, banks, are in loss and they don't want to close their trade in loss. So assuming smart money entered their buy here, they entered their buy here. No, sorry, they entered their buy here. They entered their buy here, and now another smart money or a bank, let's say here hedge fund, they entered their buy here, and now expecting to go and break structure. But another bank realized that markets cannot go to the top, so they are also trying to sell here. But this hedge fund, their money is greater than that of the bank. Let's say this hedge fund injected, let's say $10 billion from here. They injected $10 billion. Then the bank injected $5 billion here to sell. This one they injected to buy. And this bank injected $5 billion here to sell. But because this hedge fund $10 billion is stronger than the $5 billion, it came and took them out. And mostly banks and these big institutions, they don't use stop loss. It's we the retailers who use stop loss. So this hedge fund order came and took them out. So now these banks, they are now in loss. They are now in loss, and they don't want to close in loss. So what do? They realize that now the buying momentum or the buying pressure is stronger than their selling pressure. So now what do? At this zone, they inject more money to pull the price back. So once these people put, let's say, 10 billion and they got to this level, and then these people to put 5 billion and they are still in loss, now they can decide to inject 10 billion at this zone. So when they inject 10 billion at this zone to sell again by adding order, so they put 5 billion here and now they put 10 billion here, that's 15 billion, which these people have 10 billion. So automatically it will pull it back here. So when it pulls it back here, now they will close their 5 billion order they entered here at what? At break even. You get it? They also close their 10, and now this their 10 billion order is now in what? In profit. So when they close this 5 billion, they will also close the 10 billion and now continue to inject another buy order to be in direction with this hedge fund. But then this hedge fund are already in profit even at this zone. So there's no need for them to close their order here. So when the bank dejected their 10 billion, they brought to this level. Now they will close at break even and now continue to buy to be in line with this hedge fund. So that is why we have this mitigation block, which is the same thing as break and retest. So at first we were trading break and retest, and we don't know the reason why we are trading break and retest. What is the rationale behind break and retest? So this is the reason. Please, are we together?
Yes.
Okay, good. So that is a mitigation block. So now let's look at, I hope you've understood it. Hello?
Please watch. Are you making a recording?
Is it?
Are you making a recording of the
Recording?
I'm asking whether you are making a recording of the session.
Recording, yeah, I'm recording. There is an online recorder.
Okay, very good, very good.
Okay. So now look at something. For a mitigation block to hold, there are some things you need to see. That is liquidity within that zone. But we have not yet covered liquidity. So let's continue. When you go to liquidity, we'll come back and then inject it in. So now let's go to breaker block. Let me use this one. Okay. So breaker block, it is a fail order block. That is the simple definition. That's the simple definition of breaker block. So this is what we have. Yeah. So we expect price to come to this zone. So this is the break of structure here. So this is an order block or a demand zone here. So when price was coming, we expect price to respect this order block and continue. But when price came here, what happened? Price broke it. So now, when it is going by, we expect price to now what? Respect this breaker block and continue. So this fail order block is now termed as what? Breaker block. This fail order block. So this is the bullish trend. Break of structure, and now we expect price to come and mitigate this order block. But when it came, what happened? It broke that order block and then came and retested it and continue to sell. So the moment an order block, a bullish order block, is being violated, that order block turn into what? Breaker block. Or the moment a bearish order block is being violated, so this is a bearish move. So we expect, I didn't draw it well. This is a bearish move. Good. So we expect price to come in and what? Respect this breaker block, this other block here. This is a break of structure. But when price got to this zone, it may even do something like this, then break it. So when it breaks and comes back, then we are expecting it to go to the top. So this zone now become a breaker block. A failed order block become a breaker block. Please, are we together? A failed order block becomes a breaker block. Good. So now FVG, we've already explained FVG. This is an FVG. The gap between two candles is an FVG. And then we have a reclaim block. A reclaim block is more the rationale below a reclaim block is more like that of the mitigation block, but this is on a different level. So now let's see. This is an uptrend. This is an uptrend. This is an uptrend. So we expect market to come and respect this other block here. And respect this other block here. But what happened when market got there? It may buy, then break it, and then come back and continue. You get it? So this is an order block. Oh. This is an order block. This is an order block. So when market was coming, we expect market to come and respect this order block. But the order block, when it got there, price bought all right, and then it couldn't go to take this. They gave us something small, some action, and then breaks it. When it breaks it, it then immediately came back within the order block, and now retraces and activated that order block and continue to buy. Why does this happen? Why does this happen? Assuming price is at this zone, and the retail or this in the smart money or the institutions, they are not afford. They don't afford. Let's just use Bitcoin as an example. Let's say the price of Bitcoin is at 100K. It's at 100K. That is where all the institutions are looking to stabilize Bitcoin price. They don't want Bitcoin price to go below 100K. So now all of them, their order is at 100K. But now Trump came and made some small speech about crypto. And by then price was around this zone. Let's say price was around 99K. And everyone is expecting to buy when market got to 100K. Let's say it was around 101. So everyone was trying to continue with the buy when it comes to 100K. But now Trump came and made a speech which brought price down to 99K. And we all know that the institutions are not in favor of Bitcoin going below 100K. So what will happen? When price got to 99K, they will inject more money again to push it back. To come within the 100K zone. They will push it back to something like this, 101K. Now bring it back to 100K before they continue with their order. So this zone becomes a reclaim block. So most of our mentors, those who are big gurus, they use this reclaim block a lot to cut trades. And this is the rationale below it. So whenever you see an order block and you are expecting market to take out or to come and activate the order block, but when price got there, it broke it. Sometimes it will break it with a week. It will break it with a week and then comes back immediately and then pull back to that same order block and continue. So whenever you see something like that, know that that is a reclaim block. So this order block which has been violated and came back to that zone is now termed as reclaim block. And then our last area or point of interest is order block. So these 5 things, they are of hierarchy. Whenever you are trading and you see a mitigation block before another block, know very well that mitigation block may hold before even other block. But as I said, you have to backtest them. You backtest them and see. So now other block, we already know what an other block is. I explain it to be the demand zone or supply zone. The last bearish candle before the aggressive move to the top, or the last bullish candle before the aggressive move to the down. But with advanced smart money, we don't consider that definition. This is the basic smart money concept of order block. With advanced smart money concept, we look at the last candle that swept liquidity before the aggressive move to the top, or the last candle that swept liquidity and then gave us a change of character, as we discussed here. So this last candle, either bullish or bearish, it doesn't matter. So far as is that candle that swept liquidity before the aggressive move to the top and giving us a break of structure, the change of character, that candle now become our order block or demand zone. So understand that, because sometimes the order block will be too obvious. The smart money, we know we are trading against the institutions. They sometimes leave a fake blueprint or footprint for us to be trapped, because they now realize that the retail traders know the way they trade. So they sometimes try to leave a fake footprint. They know that now all smart money concept traders knows that their order block is the last bullish candle. So now when they come, they would like to engineer that bullish candle and give us a small buy, then before it breaks and come and take that last candle that swept liquidity and then continue. So now let's go to the live chart and see. So this was a trade I took. This was a trade I took on last week. That was on June 19th. I had this trade when it was around. I had this setup when it was around this. I shared it with some of my friends.
Yeah, sure.
Okay, good.
Yeah.
So now this is BTC. I trade GBP, JPY. So you see, this is BTC. This is what I'm expecting to happen. Last week I had a discussion with one of my friends and I told him this is what I'm expecting to happen. I'm not expecting price to come and take this high, because we have this swing low order block here. So this is a trading range within a trading range. So that's why I told you I showed you how to get the trading range. If we were to be waiting for this trade to come and trigger here, meaning we wait for the whole week without taking a trade, but this is higher time frame point of interest. And within the point of interest, we have a new trading range, which we took our trade from here and hit our TP here. I told him it was around this zone when I had the discussion with him. It was around this zone. And I told him that price will come here, then fall back to here. And that is what is currently happening. So I have my pending order here on BTC. I trade BTC and that of GBP, JPY. So when you look at my chart, I have 1, 2, 3 GBP, JPY. One I use for analysis, other I use for live trade, and other I use for back testing. Yes, so when price was playing out, I expected something like it gave me a new trading range. So this was my overall direction. And also last 2 weeks I took these trades also. I took these trades, yes, on GBP, JPY, and even this one I took them. So these are the trades I took on GBP, JPY. So last week I was expecting, when price got to this zone, I was expecting it to come back and activate this zone before it continued. But what happened? It came and activated this one. What is the name of this? Can anyone tell me this? The name of this? We've just discussed it. This zone that it came and activated. Is it?
That will be a breaker block.
That's a breaker block. Yes, it's a breaker block. You know, for a breaker block, you have a break of structure, another break of structure, even though this is a substructure. So from here we look at what we discussed from structure up to point of interest. Even though this is a substructure, this is a pullback. It's a substructure, and then this is a minor structure. That is the continuation trend. So I was expecting it to come back and mitigate this other block I have here. The whole of this, that and other block. So this, the whole of this is an area of interest, but I refine it to be what? To the last zone, to the last candle that swept liquidity. So that is why I brought my SL below it to be my point of interest, even though the whole of this is the area of interest. So I was expecting it to come back, but it couldn't come. It came and activated this breaker block and then continue. So now when it took us this high, it came back and activated this other block, break structure. I was expecting it to come then and activate this other block because it has sorry, I didn't discuss liquidity with you. Let's do that. Liquidity. So we all know liquidity is money. So this is a bullish trend. So we have something like this, price doing something like this. It did as if it is going to leave us and then comes back and take the order before it goes. So this zone, maybe there is some key area there. There's a key area there that people are looking to buy. So when price got there, they actually bought, but that is a liquidity zone because we have a strong area of interest below it. Let's say we have some minor break or minor order block here. We have some minor order block, but I told you this pullback is a substructure and this continuation is the minor structure. So many when the market was going to the top through the minor structure, it was giving us something like this, which is a minor structure. So most people may be likely wanting to take their trade on that minor structure order block. Meanwhile, we have the major or the main structure order block here. You get it? So this is a minor structure order block. So many people will be likely to be taking their trade there, which is a liquidity zone. The smart money concept, the smart money traders or the big institution would like to make this place look like an order block for the uninformed traders to take their trades from there. And in that case, that zone becomes a liquidity zone. That zone becomes a liquidity zone. We get it? That zone becomes a liquidity zone. So if that zone becomes a liquidity zone, then the point of interest here, it is going to be a high probability point of interest. And for us to get a high probability point of interest, we must have a liquidity present very close to the point of interest. Let's say this point of interest, this liquidity zone, this liquidity is around this zone. It's around this zone. So this point of interest is not it's not a high probability point of interest here. So if I'm taking trade, I will not set a pending order here. Let's say we made price around this zone. We made price around here. And then some will likely mark this as liquidity, but it is far from the point of interest. So in that case, if I'm going to trade, I will not take this as my liquidity. I will wait for price to come and do what we call engineer liquidity. So engineer liquidity is formed when a point of interest has no liquidity around it. Let's say we have something like this. So now we have something like this. So this is our point of interest. This is our point of interest. And now we are looking to take a sell when price gets there. So now you made the price here. You cannot set your pending order here. You cannot set your pending order here. Assuming you made price at this zone, around this level, you cannot set your pending order and waiting for price to come and trigger you. It is very wrong. Simply because there's no liquidity around the point of interest. So now let's say price was coming, and then it got to this zone. It can come and take you out because there's no liquidity. So for you to set a pending order, you must see price doing something like this. Then do as if it is going to buy, There, when you have something like this level now become an engineer liquidity. So in that case, you can confidently set your pending order here, waiting for price to come and activate it. And that was what I did on this trade. On this trade. On the other trade I showed you. Let me see, there is a trade which has no inducement. Good. Here, this trade, this one, I made the market when it was here, then I marked this point of interest, but by then it wasn't having inducements. Let me see if I can see that trade. I made it there where it wasn't having inducement by then. It wasn't having inducement. Good.
Please,
Yes.
I don't know.
Yeah, you can talk.
I'm talking about I can. They swing low and swing high. Which particular time frame?
Swing low and swing high. Oh, a swing low, it depends with the type of trader you are. You get it?
Yeah, okay.
If you are a day trader, you use 1 hour time frame. This one. Oh, okay, this one.
Yeah, your chart.
Yeah, I use 1 hour.
Yeah, your chart. Yeah.
Yeah, I use 1 hour. You get it? Already I did my markings. I already know from the higher time frame that GJ is on a bullish trend. So there's no need for me going to daily, weekly again. I already know that GJ is on a bullish trend. So when you go to the top down analysis, you will see it there. I want to show you the trade. I shared it with them. I shared it with my friends now. When price I shared it with them before it's activated. All the trades I took, I shared it with my friends. Okay, but let's continue. It's too far. That was last week or last 2 weeks. Okay, so let's continue. You see here, price was coming, but some people may likely take this zone, this one, as a liquidity, which is too far from the point of interest. So in that case, I have to see price engineering. So when it got to this level, it did as if it was going to buy. So most people who are impatient will likely jump to this trade and start buying. Then put their SL here. Then price will come and take them out before it goes up. The same thing here with this trade. Look at it. With this trade, it is too clear. The point of interest is closer. The inducement, that which is the same as liquidity, the inducement is closer to my point of interest. So there's no need for me to wait for any point of interest, any engineer liquidity to occur. So I just set my pending order, and then it came and activated it. So the moment you see a point of interest without inducement, you have to wait for price to engineer liquidity. But if that point of interest has inducement, then there's no need for you to wait for price to engineer liquidity. You can set your pending order and then you continue and do the thing that you are already doing. Just set the pending order and leave it. Price will come and hit it. So this was the trade. This one, that was the second one I was showing you. This one, I shared it with them when it was here. You saw it. We can see it, right? I shared it with them when it was here. And then price actually did the same thing I did. So let me use this and explain this thing for you. Let me use it and explain it for you.
Okay.
Let me use it. Good. Or I should just clean. Let me just clean the chart, and then we do it together. Let me just clean the chart.
Very
Yeah. Let me just clean the chart. Okay. So let me go back and share this screen. Okay, GG. Good. So now let me use which one? This one. No, let me use this one. Okay, you see this reclaim block? No, this breaker block. This was what happened here. So let me just use that one. Okay, good. So let's look at the recent trade. So first, I'm a day trader. I go to the 1 hour. But before I go to the 1 hour, I will have to, let's say this is my first time trading this pair. So I cannot just go to 1 hour and do my analysis, because I have to know my direction. In that case, I go to the daily time frame. Mostly I go to daily time. If I don't go to 1 month, weekly, no. I go to the daily time frame. So look at this. From here, market was selling. Then it got to this zone, and then came here and continued buying. So look at this on the daily time frame. We say to get our swing low or the beginning of our trend, what do we need to see? We must see a sweep of the previous low. So this was market selling, lower low, lower high, then lower low, but it couldn't give us a lower low because it broke that level with a wick. You get it? This is on the daily time frame. It broke that zone with a wick. If this market is going to continue to sell, if this market was going to continue to sell, it will have broken this zone with a wick or with a body candle, retraces back and continue. But what happens? It took out this last low. Here, this was the last low, this candle was the last low. So this bullish candle came and took out that low with a wick. So that level now signifying a low, but it's not yet confirmed as what? Our swing low. It's signifying a low. So now what happened? When price was coming here, it gave us something like this, then retraces, and then came back. It couldn't take that low, but rather came and took this high. So this was a high. It took it. So that is a first sign. I told you, for a first sign of a swing low, we must get a what? Change of character. So the daily time frame, this is a change of character. So now it went and came down, then what? Broke structure. So in the daily time frame, this has been confirmed now as our what? Swing low. And the moment we have a break of structure and a change of character, that also confirms the beginning of our what? Trend. When you have a sweep, change of character and break of structure, that confirms the beginning of what? Our trend. So this shows that we are on an uptrend on the daily time frame. So now, what do we need to do? We go to the 4-hour time frame. I'm now doing the top-down analysis like that. We go to the 4-hour time frame. So on the 4-hour time frame, we've already confirmed this zone as our what? No, sorry, on the daily time frame, we've already confirmed this zone as our what? Swing low. And then we had this change of character here. This change of character here on the 4-hour time frame. So now on the 4-hour time frame, we have this change of character, which is also aligning with the what? with the daily time frame. We have this change of character here. Then we have another break of structure. This is also a break of structure. This one is also a break of structure. And then we have this one. That's 4 hour time frame, oh please. We have this one, also a break of structure. Good. So now look at it from the 4 hour time frame. We are currently here. We don't have to look at what is happening from this place. From this place to this place, we don't have to look at what is happening. We look at where price has break the last break of structure on the 4 hour time frame. So this zone we are now looking at. Are you getting it? We don't need to look at what has happened previously. We look at the current price range where price has broken the structure. So that zone now become our 4 hour swing what? Our 4 hour low. Currently we've not yet confirmed our swing low. But for us to confirm it as a swing low, we look at the substructure that price was creating where it was coming down, giving us this, and then it get taken out. You get it? So this is the main structure, it is bullish. This is the main structure, which is bullish. This is the substructure, which is bearish. And for us to confirm, we must get a change of character for this new minor structure to align with the main structure. You get it? So now from here we have this last break of structure, and then this candle, look at this candle, this one that I marked my low on it, swept this liquidity, this last low is a last low. It swept it. You see, I didn't mark the pink candle, but I marked this gray candle. Why? Because this is the candle that swept the last low. This gray candle, this pink candle couldn't sweep this low. If like this candle swept this low, then this one will have been our swing low. But it was this one that swept the low before we have the change of character occurring. So now this is our change of character occurring, and we know how a change of character occurs when price takes out the previous high. This was the last break of structure on the 4 hour time frame. So under normal circumstances, if this price is going to continue to sell, when it got to this last level, it should respect it and then continue to sell. But what happens when it got to that zone? It actually respected it more, but it couldn't take out this low. This was the last low created before this pullback. It couldn't take out this low, but rather continue to give us a higher high. So that place becomes a change of character, which is the first sign for what? For our trading range to be confirmed. So now the other thing we need to get is what? A break of structure, which has occurred here. But this break of structure, it is not the main break of structure. The main break of structure is from here to here. That is the main break of structure. But this break of structure we are getting, it is a minor break of structure, the internal break of structure on the main structure. You get it? You have to understand it. That's why I started with the textbook perspective.
Yes.
You get it? Hey. So this is a substructure, that is a pullback, and then this is a minor structure. The small structures form within the main structure or the continuation structure. So now look at something. For us, let's say assuming, let's say, let me just cut here. Let me cut here. Good. I want to explain that thing I explained earlier on. Our swing structure and our swing low and swing high. So I told you something. For us to confirm this high here, this is our high. Currently, this is our last high. This is our last high. This is our last high. Let's say we didn't get this break of structure. Let's say what we saw earlier didn't play. Let's say we made the market here. So this was our high. So for us to confirm a new high, we must see price coming to take out this last break of structure low, this zone. You get it? So that we've already confirmed this as our swing low when we had the break of structure. So this is still on the 4-hour time frame. That is if you are a swing trader. But I took this trade on the 1 hour. I'll go to the 1 hour. But let's do this on the 4-hour before. So this one has already been confirmed. I know we all know why we confirm this as our swing low, because it has swept liquidity. It swept liquidity, then gave a change of character and then break structure. So now for us to get a swing high, so that we can establish our trading range to know where we are going to focus on taking our trades, we must see price taking the last break of structure low. And in this case, where is the last break of structure? Here, this is the last break of structure. So we must see price taking out that low to give us what we call a minor change of character. So look at something new. This is a minor change of character, because you know this is a minor structure. Are we together? This is a minor structure. So when price takes out that low, we call it a minor. That's why I term it as M change of character. Not to show that the whole trend has changed character. That's where most people had it wrong. When they see something like that, they think, oh, now DJ is on a bearish trend. So they will start looking for a sell. Yes, you can look for a sell, but that sell you are looking for is a pullback to this point of interest to continue with the buy. It's a pullback for this point of interest to hold. You get it? So when you are taking a pullback and you get to this level, you are taking profit. You don't expect price to come down here, because this is a pullback on the minor structure. The major structure is bullish. So now that we have gotten this candle taking out this last low, so we can now term this one as our what? Our swing high. Then leaving this one to hold as our main structure high. You get it? Are we together?
Yeah.
Good. So now what we need to do is to, once we've gotten our swing high and swing low, what we need to do is to take our gum box or Fibonacci tool, draw the range. So now this is where we are looking to take our trade. And now you have to look at the premium and the discount. So price is currently within the discounts, because it has swept it with a it has swept it with a week. So we cannot still confirm that it is still in a discount, because it has not yet closed. This is a 4-hour candle. It must close within here. The body must close inside this discount to confirm, because it can go back and close in the premium. So now within this discount zone, we have 2 points of interest. So now look at what I'm saying. The normal smart money concept trader will take this level as its order block, because that is the last bearish candle before this aggressive move to the top. You get it? That is a normal smart money concept trader. But for us who understand that a point of interest or order block, it is the last candle, the last candle that swept liquidity. So now the whole of this zone is our area of interest. Yes, the whole of this zone that I've marked is our area of interest. But we know that from liquidity concept, we know that to get our area of our point of interest, it is the last candle that swept liquidity before we have aggressive move. So once a smart money basic trader will consider this as point of interest, we those who understand liquidity trading concept will take this one as our point of interest. But look at this, even though sometimes price may likely come and respect this one, Price may likely come and respect this one, but most time it will use them as inducement or liquidity to come and take this order. So in this case, I trying to take this trade, I will mark the whole of this as my inducement. You get it? Even though I'm not taking trade on the 4-hour time frame, when I go to the 1-hour time frame, I may likely take it here. So look at something. Look at something. I told you that we have what we call efficiency and inefficiency in the market. You get it? Even though our liquidity concept also told us that the last candle that swept liquidity is the point of interest, but when you look at that candle, it has been mitigated. So that candle, it is efficient. And we know what mitigation is. Mitigation means when a price comes and activates a point of interest, it has been mitigated. So the likelihood of price coming back to that zone, it is too rare, because it has already taken the order there. So it will not come back there. It will come to the place where others are still left. So now in this case, this place may likely be our point of interest, because the whole of this has been mitigated. This one was mitigated by this candle, and then this one mitigated this candle. So the only zone that is not mitigated is this small candle here. So we marked it, the whole of it, as our point of interest. So when we go to take our trade, even though in certain our SL, we will cover the whole of this and still bring our SL to be below the swing low in order to be on the safest side. Then we can target this 4-hour high. And in this case, we are getting 1:3. Mostly I go with 1:3. You see? So in this case, I can confidently set my penny order, because this zone can serve as my inducement, because it is closer to my point of interest. And even the whole of this is an inducement for me, because I know the uninformed traders or the basic smart money concept traders are likely to take their trade here, which price may come and activate it like this, give them some small profit before it comes and take them out and continue. So you see how we mark the trading range. So now let's play and see whether it actually does something like that. You see what I'm saying? Can you see it? Please, can you see it? You see,
yes.
When price got there, it bought. Look at it. It bought and gave them some small profits before it took them out, because it is too obvious. So a point of interest that is too obvious is likely to be an inducement. Because every normal trader knows that this is an order block. So smart money concept knows very well that all traders will be likely to buy here, So they will use them as inducement to show that yes, when it came there, they will also buy small. So that I say, oh, they are buying, let's join them. So they will go small, then comes down here. In that case, the smart money, they will still be in loss, but because they have huge fund, they don't care. They want to collect all the retailers' orders, because that's liquidity, and it's liquidity that fuel market. You get it? So if there's no retail traders, the smart money will not also be able to get their trades to buy. So they always try to induce traders to enter early before they also continue with their order. So if they want to buy here, they will induce traders here by leaving some clear footprint here. So they've now left their footprint, because basic SMC traders know that an order block is the last bearish candle before the aggressive move to the top. So they will likely to buy it from this last order block, and it actually bought, but that is not the correct place to buy. So we, those who know very well that it is the candle that swept liquidity, or the nearest candle closer to the liquidity sweep. In this case, if you also don't know what efficient market and inefficient market is, you will be still waiting for market to come here. You will still be waiting for market to come here, and it will not get there. And you say, oh, I've missed trade, I've missed trade. Not knowing that this zone has already been mitigated. So the next point of interest should be the one closer to the candle that swept liquidity, the inefficient zone closer to the one that swept liquidity, and which is this one. Why is it inefficient? Because it has not yet been mitigated. Look at it. We have fair value gap there. This. At first, this is the whole fair value gap area here to here. But price came and what? Mitigated small. It came and mitigated from here to here, leaving another fair value gap here. So meaning that point is still what? Inefficient. It must be filled. You get it? It must be filled, and that is what happened. Price came and filled it, activate the other block around there, and continue to buy. So this is on the 4-hour time frame. Now let's go back to the 1-hour time frame. So the moment I do my analysis on the 4-hour time frame, I don't take trade on the 4-hour time frame. I go to the 1-hour time frame to do another adjustment, and then move to either 30 minutes or the 15 minutes. So now let's go to the 1-hour time frame. 1-hour time frame. Good. So now this is where we are on the 1-hour time frame. This is where we are on the 1-hour time frame. This zone has already been activated. So now we don't need this one again. We don't need this again. Whatever happened here, we don't need it. We are in look for this. We are now going to base our trading on this. So let's continue. Look at something here. Here, when price got to this other block, it gave us something like this. On the 1-hour time frame, it did what? It swept this zone. You get it? On the 1-hour time frame, you know that the main structure is bullish. So this one here, that's what. Can someone tell me the name of this move? What type of structure is this? You say?
Substructure.
Substructure. So this is a substructure. This one is the main structure. This one is the main structure. So this is a pullback substructure, and this is a minor structure. If you understand this, then you are almost getting it well. Okay, good. So now, when the substructure was coming, it was now coming with a bearish momentum. So you cannot be buying when the market is coming with bearish momentum. So when you go to this 4-hour point of interest, yes, I took this trade on 1 hour. So I even refine it to this zone. So when you look at that my market, you will realize that it came and tap it and just go here. You realize that it came and tap it because I took it on the 1 hour. So I refined that zone. No, it's not this one. I refined that zone. Where is it, Kura? Okay, I know I refined it to this zone. So it just came and tapped. Okay, no, I didn't refine it. I took it like that based on confirmation. Oh, no. I refined it. I know I refined it to this zone. And then I took it from here. Okay, so let's go back to what I'm saying. So now we are in 1 hour time frame. We are in the 1 hour time frame. Where is it? Okay, good. So on the 1 hour time frame, we know that before price tap on this our point of interest on the 4 hour time frame, it swept the last low. So when price was coming, it was giving us some bearish momentum, doing something like this. Here it did as if it has changed character, but this zone is there. It activated it, then came here, did something like this, did this, then came and swept this zone. Before it what? Took out this high and then broke structure. So this trade too, I took it. And most people from our group they were asking me why I took this trade. I took it because of this one. It was too obvious. People will likely take their trade here as their other block. And also when you look at it, it's more or less like a breaker block. So many people will likely take their trade there. Meanwhile, I know very well that DJ respect other block. So that was why I took that trade. Good. So now let's continue. We are not looking to take this. We are looking to take another trade. So now look at it. It broke. It swept this liquidity here. It swept liquidity. Then what? Broke structure. Broke structure here. No, sorry. It changed character. Minor change of character. So now here become our what? Here become our what? Here. Can someone tell me?
The swing low.
Swing low.
Okay, minor swing low.
Yes, 1 hour swing low. So mostly I do my markings like this. H1 swing low. So now let's go. We already have our swing high here. So in this case, price has already activated here on the 4 hour time frame, but it swept it. It swept it. It didn't activate. Okay, good. So we already have our 4 hour swing low here. Our 4 hour swing low, swing high here. So now we now have our 1 hour swing low here. What do we need to do? We need to get a confirmation for a new 1 hour swing high. Other than that, this 4 hour swing high still holds. So now this is when price was going. This was the last break of structure to the top. Can we see it? That's the 1 hour structure. The 1 hour structure. This is the last break of structure to the top, and this is the what? The last low that causes the break of structure. Is that not it? That is the last low that causes the break of structure. So now here has now been confirmed as our new swing high for the 1 hour. For the 1 hour. So now where is our trading range? From here to here. So, and we know the market is already on a bullish trend. We are not looking to buy. But to be frank with you, here I took some sell. Because I realized that before the market, because it took like 2 days before it got to this zone. So I was able to get this zone to sell. Here, after getting this sweep on the 50 minutes time frame. I went to the 50 minutes time frame. I got this zone. And then now let's say we are going to buy. We are not taking counter trends. Mostly I don't take counter trades unless I see a strong reason to take. I always wait for the buy. If the market is on a buy, I always wait for the buy. So now look at something. When I saw this, now I realized that price has already mitigated this. Please, I'm coming. All right. So now look at something. When price was going to the top, when it gave us a change of character here, it came back and activated this, which I told you I took this trade. I took this trade, yes. So it has been mitigated. This zone has been mitigated. And we know that our point of interest is the last bullish candle, where it is the last candle that swept liquidity. So the whole of this one has already mitigated. So now which one is the nearest? This one, the whole of this is the nearest. That is the nearest. We can even add this one. Good. That is the nearest. And now looking at it, we have an inducement. It is closer to our point of interest. An inducement can be 1 candle sweep, 2 candle sweep. It doesn't matter. Any pullback before it goes to the top is an inducement or a liquidity. So this is an inducement. It is closer. When it gets here, most people will likely want to buy. When you go to a lower time frame, here can be an order block. But because this is on the 1 hour time frame. So look at it. Now this is an inducement on the 1 hour. Assuming I'm not taking trade on a 1 hour, I'm taking it on 30 minutes. So let me go to my 30 minutes for zone refinement. But I've already did my market on the 1 hour. So let's go to the 30 minutes. 30 minutes, mostly 30 minutes swing low and swing high is the same as that of the 1 hour. Or even the structure on the 1 hour is almost the same as the one on the 30 minutes. So look at it very well. Now on the 30 minutes, you see, you can clearly see that break of structure, because on the 1 hour time frame, some will say it is a liquidity sweep. So now we are back to the 30 minutes. Look at it. So here, look at it. The whole of here, some people will be likely want to take their trade here. The whole of this. Most people will likely want to take their trades here. And then they would say this is their liquidity. They will look at this as their liquidity. As their liquidity here. And then that's down there. They will look at this as their liquidity. And here as their point of interest. Forgetting that, because they will think this candle swept liquidity here. This one swept liquidity. Which they are alright. They are right. But they are not also right. Because the main structure we have here, we have a low, a high, higher low, higher high. Then we have some small pullback. We can call this as higher low, because it must go deep within the discount before it continue. So this is the main structure. The main structure, higher high, higher low, higher high, higher low, higher high, higher low. So now on the substructure, that is what we are down backing. So most people will likely want to take their trade here, which is an inducement. So me, the one who understands liquidity trading concept, I will like to take my trade below. So now what happened? I will set my pending on that, because the price is closer, the inducement is closer to my point of interest. I will likely set up, even if I want to be safe, I can still bring my SL below the swing low. But in this case, I know since this place has been mitigated already, I'll just leave it like this and then target the high. You see? So now let's go and see what happened. So you see, I told you, good. I told you that I had some buy here, where some sell here. I had some sell here. Why? Because when price got here, it engineered liquidity. Previously, when price was here, there was no liquidity here. There was no liquidity, so I didn't want to take trade without liquidity. But when price was now making a pullback, it engineered liquidity here. So that was what gave me the confidence to take that sell. You see what happened? It did as if it was coming to sell. Then we call this engineered liquidity. It engineered liquidity there. Then what happened? It now moves back and what? Activated that zone. See what happened? It moves back and activated that zone. And then what happens? It's like that was on the NFP day. No. Okay, and NFP even brought it further down. You see what happened? So, but to be frank with you, when price got to this inducement, I closed that trade. Yes, I closed that trade when it got there. Then I set my buy pending order, because this is just a pullback I'm trading. I know the overall trend is bullish. So now what happened? Let's see. You see what happened? It came and swept them straight. Let me see, is this NFP? Good, that was NFP. I know I catch NFP too. Why did I catch? How did I catch NFP? I use what we call chart patterns. You know, if you trade chart pattern, also you know this chart pattern. This is a rising wedge. So when it broke here and then retested, I took this trade from here. I added position and targeted here 1:2. I targeted here. And then price came, NFP came and swept them, tapped at the exact points. You see what happened? it tap at the inside point. So if you understand trading range and liquidity sweep or liquidity concept, you can always get a sniper entry. You see what happened? So as price was playing out, I was doing another analysis within this minor structure so that I can get another entry to add. So let me remove this thing here. So now look at something here. Price swept this low. It swept this low. Now it takes out this last high here. It takes out another high to give it a break of structure. Takes out this high. So now I was expecting price to come and take this low to confirm my now new trading range to be from here to here. So I was expecting price to come and take here, but I've already confirmed this as a swing low, 30-minute swing low here. This one, 30-minute swing low. So I was waiting to get a swing high on the 30 minutes. So what happened? Let's see what happened. Okay, you see, price couldn't come and take it, but rather went and swept. Okay, it's a liquidity sweep. So it couldn't come and take it, but I already have my first position running. Then it went and gave us a break of structure here. And now this become my now last low, waiting for price to take for me to get a swing high on the 30-minute time frame. The price didn't do that. It went and hit my full TP. So now this new trading range I'm looking to add position has been inviolated, so I'll cancel it. We now understand it. So I cancel it, and now this my swing high is also violated. It has played, done its work. So now the whole of this become the overall trade break of structure. The overall trend break of structure, and this one becomes now our new swing point for the new trade, for the new trading range on the higher time frame or on the overall trade. So now how do we get another position from here to here? Let's see. From here we have another break of structure, or another sweep here. We have another sweep here, and then break of structure, break of structure, break of structure, break of structure, break of structure. So this is the last break of structure. We've now confirmed this new one here as a swing low, 30-minute swing low. So now let's wait and see if price can take out this for us to get a swing high. So let's see. Price didn't do that, but rather gave a new break of structure, and good. Now price has what? Confirmed this as our swing high. You see, sometimes the trading range can be huge, and sometimes it can be small. So now this is now a new trading range. This is where we will likely take our trade. So this is our discount zone. We are not going to take our buy here, even though some smart money traders, those who don't understand the concept of liquidity, will likely take their trade there, which is also correct. It is also correct because market can do anything. Because I know someone who trades just this. I know one lady, she's very good. She trades this thing alone. She trades this only the basic smart money concept, and she makes money. So they can decide to take their buy here, but for me, I'm going to wait for price to come to this zone. The candle that swept liquidity, that is what I'm waiting for it to come. So now let's see what happened. Good. You see here, good. So these people, if they take their buy here, they are correct because price engineer liquidity here. But I will not take my buy here because price is still in the what? In the premium zone already. It is even in the premium zone, so I will not take my buy here. But those who take their buy here, they are alright, they are correct. Just that their risk to reward will be small. If they take buy here, they are targeting here, which is 1:7 risk to reward. 1 is to 1.7 risk to reward, risking 48 pips for 84 pips, which is good for some people, but I will not take this. I'll wait for it here. And in this place to look at something here, I will not set pending order. Why? Can someone tell me why? Good. Okay, I can set pending order. It is closer. Yes, I can set pending order. I can set pending order because it is closer. At first I was thinking it wasn't closer to this my point of interest. The whole of this, they are all liquidity. The whole of this. If we get time someday, we will talk about internal range liquidity and external range liquidity. The whole of these are internal range liquidity. So price will have to grab them in order to come to this point of interest and then go and take the external range liquidity. So now let's see what happened. Those who bought here, they are in profit. Let's see, they are in profit. What happened? What happened? They are in profit. Boom. You see what happened? They are in profit here, and then price came and what? Swept them, and it's now approaching our point of interest. So we can set pending order here, and then target that same swing high. So now this is our 30-minute swing high. It has been confirmed. Why do I say this is our 30-minute time frame? Can someone tell me? This is our 30-minute time frame swing high. Why? Because price has taken out the last. Yes, price has taken out the last low. That is the minor break of structural low. And then it has been confirmed. I told you before a swing high can be confirmed, the last low should be taken out. The last low that gave the minor break of structure should be taken out. And before a swing low can be confirmed, price must sweep liquidity, change character or break structure, and then another break of structure. So now let's see if we are right. Mostly I would like, if I want to be on the safest side, I can still target even here as my SL here. But in that case, I will not get my risk to reward to be right. So I would rather target this. I would rather target this here. Here. Why? Because when you look at this place, look at something here. When you look at this place, price didn't mitigate the whole of this. We have some hidden point of interest here, which price can likely come and sweep. It can likely take our first point of interest and use it as inducement and then come here. So in that case, I will target here because I will always target 1:3, which will still give me my 1:3 risk to reward here. It will still give me my 1:3. But if I am going to look for more risk to reward, I can target here. The price can sweep me, tap on this one unmitigated zone. So in this case, I will term it as unmitigated zone, so that I can know there is a zone which has not yet been mitigated. So any day, any time price is approaching there, I will be looking for some confirmation and take trade there. So now let's see. Now I'm targeting here. I'm targeting here to get my 1:3 risk to reward. So let's see what happened. Let's see. So you see, when price got to the inducement, it is trying to engineer liquidity again to lure people to buy. You see, to lure people to buy. It came to the inducement and it is buying. So those who are not aware of inducement will likely buy, especially when they see this tweezer bottom candle. I know we know about candlestick anatomy. These two candles, we call them tweezer bottom. Especially when they see it, and it is a sign of bullish momentum. So when they see this tweezer bottom, they will be likely jumping to the trade. They will likely jump to the trade. Oh, the price is leaving us behind. Let's follow. Let's buy. Then they will start buying. But we, those who understand liquidity, will wait and see what happened. You see what happened? Price now came and tapped on our zone. And see, good. See something. Look at something. You see what happened here? If I was to say I'm going to get correct risk to reward, putting my SL here, it will have hit my SL and continue to buy. In that case, we call it liquidity grab. So I still put it here to get my 1:2 risk to reward. And then let's see what happened. You see what happened? So that's why sometimes it's good we look at, we have to know what is happening in the market. So that even when you hit SL, you know the reason why you hit that SL. So you see what happened? Good. So now, this is where we are currently. This is where we are currently. Yes. You see, this trade, this is where we are currently. And those who are waiting for this zone to come and tap, it has tapped them in. And yes, to be frank with you, this was where I took my trade. I showed you that trade in the morning. I didn't use this zone. I still maintain this zone. It tapped here, it came and tap and go. But if you also took it from here and still target this zone low as your SL, you are still in profit. So that is why sometimes we say no one is wrong until the market proves you wrong. So you see what happened? Boom, price is going. Price is going. So now from here, we are currently here. This is where we are currently. This is where we are currently. That is where market closed. That is where the market closed. So now let's look at the way forward. Next week, what is going to happen? Good. So now this swing low has done its job. Now we have a new swing low here. So this has broken. This has what? Swept liquidity. This candle. It is a perfect liquidity grab sweep. It has swept liquidity